Hello, everyone, and welcome to our presentation today, Risk Mitigation with a Private Insurance Company. We're delighted to have you with us as we dive into today's important discussion on private insurance. We've got a delightful discussion ahead, so let's dive in. Our speakers today bring a wealth of experience and insight. Craig Clemens, having a Fortune 500 background as a seasoned C-suite executive, leads business development for private insurance platforms in more than 30 U.S. markets. His extensive background in sales, marketing, and leadership, along with his commitment to financial and risk management education, makes him an ideal guide for today's topic. Joining Craig is David Auer, founder of Provident CPAs and Physician Tax Solutions. With over 35 years of experience as a CPA, speaker, author, and consultant, David is recognized for his expertise in tax and financial planning. He holds multiple advanced degrees, including an LLM in taxation from NYU and several other professional designations. David's insights into tax and financial strategies are invaluable, and together they have partnered to establish Alliance Reinsurance Company. Also, joining us is Daniel Tanner, Client Service Manager at Alliance Reinsurance Company, and I'm John Auer, also a Client Service Manager at Alliance Reinsurance Company. We're all excited to help guide you through this session and share meaningful insights into how private insurance strategies can strengthen your financial plan. A quick disclaimer before we get started. Please note that the information provided here is general in nature and may not apply to individual situations. Captive insurance and alternative risk planning involve complex legal, tax, and financial considerations, requiring the guidance of experienced professionals. This presentation is not intended as formal legal, tax, or financial advice and should not be relied upon as such. All right, to go over the agenda today, we're first going to go over the big idea. Then we're going to talk about what is a private insurance company, the history of private insurance companies, why create a private insurance company. Then we'll review types of insurable risks, go over some actuarial assessment samples, then review the benefits of a reinsurance company, the ideal structure of a reinsurance company, and then we're going to go over the ER3 plan and wrap it up with Q&A and next steps. I'll now pass it on to Craig to start the presentation.
John, thank you so much. I'm excited to share what's going to be in front of your eyes here over the next few minutes. Basically, the big idea was we're taking two platforms. We're going to take the power, popularity, and profitability of private insurance, which is approaching $1 trillion in assets. It's been around for several centuries, and combining that with a Roth IRA. So in a sense, we're not being capped by traditional Roth limits. And because we're using private insurance, we're super funding what all CPAs love, which is a self-directed Roth/retirement plan. So that's the big idea. What is private insurance? Well, simply put, some call this self-insurance or reinsurance. It's a smart way to fill in gaps on top of your commercial P&C. So we're not canceling or replacing your State Farm or Travelers or Geico. We're identifying your risk profile and you're self-insuring against those risks in an independent coverage. So think of it this way. We're helping you insure your underinsured and uninsured risk. And that's why 92% of Fortune 500s use this tool. So the history is pretty interesting. If you're a history buff like me, this goes back to late 1600s when maritimers went out to hunt for whales. Whale oil, remember, lit up and fueled the original 13 colonies. Well, Lloyd's Coffee House self-insured those ship owners and maritimers, and you might know Lloyd's Coffee House today as what? Lloyd's of London. Advanced to the 1700s, a lot of underinsured entities popping up in the original colonies. Ben Franklin was actually involved in one of the very first self-insurance companies. In fact, it's still around for what, 3 centuries, 4 centuries now. In the 1800s, what blew up was what? Steam engines. Steam engines fueled the Industrial Revolution. So now people got involved like Henry Ford and Andrew Carnegie and Mayer Rothschild. So those big entrepreneurial pioneers in the Industrial Revolution used private insurance so that they weren't hung out to dry. They had to self-insure their risk exposure. And then, of course, in the 1900s, it was more formalized, and everybody's in the 60s and 70s, 80s. Think about people like Mitt Romney and John Kerry and Pelosi's go down the list. They all parked their insurance companies offshore in Bermuda and Nevis and Turks and Caicos. So they've been popular forever. We have probably a great mousetrap that you're going to learn about today, taking advantage of this centuries of of history. Is it a big market? Yeah, John, it's a huge market. Today it's $800 billion. It's doubled since 2013. In the US, the number is 630 billion, but globally speaking, it's approaching $800 billion. There you go. 5.5 increase in 2024. And today we're right around that $800 billion in assets of private insurance. So been around a long time, huge market. We like to put this little slide in anecdotally. You know this guy in Nebraska, Warren Buffett. He's been doing this for 5 decades. So he owns Geico, right? Berkshire Hathaway owns Geico. He also owns private insurance companies. He is stacking up $150 billion in premium. When he does that, he goes out and buys stock in NASDAQ like McDonald's and Amazon and Apple and Google and Pepsi. When he buys stock, he's buying that with what? Premium. You can do the same thing. You can push off premium off your books as a business expense, stacking that in a self-directed Roth, and then you're going to have custodial privileges to buy those same stocks we just mentioned. So really, you're going to be probably a mini version of what Warren Buffett's doing. Who can participate? We'll look at all the channels, the industries that can participate, really all of them. The only thing that separates, the cannabis channel from an orthopedic surgeon is what? His risk profile. So when we are allowing business leaders to insure their underinsured risk, it could be hospitality to real estate to oil and gas and energy in Midland, Odessa. So the actuary is really key to understand, identify, and validate the risk profile of every one of our clients. There's really 4 motivating factors where you want to get involved and turn this tool on. The obvious ones we always get is to minimize insurance cost. If you're stacking up premium and you're self-insuring your risk, can you go back over to your P&C guy and raise your deductible and lower your premium? Yes, that's done all the time. You're balancing and blending your risk management, if you will. You're controlling risk, you're improving your cash flow, and of course, long term, you're building up some substantial wealth. This slide we built with JP Morgan and they're training CE. They got credits for this. We're not replacing your auto, your GL, and your workers' comp. What we're doing is identifying the risk on top of those pretty standard P&C coverages, right? We're going to look at things like business interruption, loss of key vendor, loss of key supplier, loss of key contract. How about loss of key talent, like a key man policy? E&O, D&O, your legal risk, your regulatory risk. How about business interruption like COVID? If you owned 15 restaurants, were you impacted by COVID? Sure. So all of these things that are, again, where you are underinsured, we are going to identify and drop that into the policy. Our first example, David, is commercial construction. So this guy's in Missouri. You can see his risk on the left of where he's underinsured. Of course, this is on top of his P&C policy. We're not duplicating coverages. Bottom of the page, he's doing $15 million annually in top line revenues. He can push off his books 1.5 million or 10% of his top line revenue. The next example we have is healthcare. This is a smaller guy doing 5.5 million. There's his risk on the left, sitting on top of his P&C risk and his medical malpractice. And look what he can push off his P&L every year, 10%, 581,000. So there again is the 10% rule of thumb. Next example is another healthcare person, $14 million. There's their risk on the left. This guy's in pain management. And he's just under that 10% rule of thumb. He's doing 1.2 million. So he's just under 10% as a percent to his top line revenue. Dentist. This gentleman's doing $8 million in top line revenue. Bottom of the page, there's his risk on the left, A through Q, validated by a third party actuary. He can push $1 million a year off his books as a business expense. So, David, you're a CPA. You understand in 10 years with investments, this guy's probably going to be 13, $15 million in sitting in his Roth IRA. Wonderful. I think this might be the last one, hospitality. So, this gentleman owns some restaurants. There's his risk on the left, A through O. He's doing about 5+ million in top line revenue. There's that 10% again. Actuarially, he has about a $500,000 of risk. That's what he's punching off his P&L as remitted premium. Okay, David, that's kind of the history and the scope and scale of private insurance. And now it gets interesting because we're going to have you unpack how it evolves into the Roth piece.
Great, thanks, Craig. That was a very good overview of the history of the private insurance industry. And then I really liked seeing the specific examples on the case studies, on how much risk some of these businesses can self-insure for. And keep in mind that you do not have to have this be your full-time business. If you had a side gig, you might be a full-time employee, or you have a W-2 somewhere, but you have a side business that has potential business risk. You can also do this, even with part-time business investments that you might have. So anyway, let me go into a little bit of a explanation or a background on the tax law behind the private insurance industry. So, like Craig said, they've been around for a long time. In 1986, under Ronald Reagan, his presidency, there became a new code section for specifically carved out for smaller businesses to be able to experience, the self-insurance, business model. That was under Section 831B. It had some very favorable incentives for small businesses, where they could pay premiums up to a certain dollar amount. That amount is increased generally every year for cost of living. Right now it's $2.85 million. And then that gave there was a booming industry out there of companies that help businesses set up their own what are called micro captive insurance companies. The challenge has been over the last 10, 15, 20 years is that there's been a lot of abuse, not obviously by what the tax law allows, but by people who just don't follow the rules and use these more as personal checking accounts or to own personal assets, or just not do things that are appropriate under the tax law that the intent of this statute was for. So as a result of that, IRS has gotten involved, and they have this on their radar screen, to look at businesses who have set up a private insurance company, and then they check the box on the tax return that they want to be taxed under this Section 831B. Very clearly, in this situation, what we are prescribing to is not a Section 831B organization. Those are out there. There's companies that can set those up. We have fall under what all the larger companies have set up, the Fortune 500 companies that Craig mentioned, and the opportunity that we created is under Section 831A, which is what most of the big companies use. Little different tax treatment on the treatment of income and expenses, but for the most part, it's unlimited in terms of how much premium a business can pay into it. Unlike on the micro captive, it's all based on what an actuary can come up with in terms of legitimate, insurable business risk. So anyway, just real clear cut, what the model that we are embracing, with Alliance Reinsurance Company is the one under Section 831A, which is not on the IRS's radar screen. Not that 831B companies are per se illegal. It's just that they're just much more scrutinized. So I go through. I won't go through all of these details into the difference, but let me talk about how a traditional micro captive insurance company is set up. So generally, the first thing you do is you identify, what jurisdiction you want to set this up. Like Craig mentioned, it was popular during the 1960s and 70s and all the way into the 80s, of going offshore and finding in foreign countries were establishing self-insurance or private insurance statutes to try to attract capital to their countries. So that was very popular back then. And then states started enacting legislation over that same time period to try to draw companies into their states. So it's become a fairly competitive environment. But anyway, when you establish a micro captive, the first thing you do is you identify what jurisdiction you want to set the entity up. It does not have to be in the jurisdiction or the state that your business is domiciled. You can pick and choose which one is more favorable. Ownership requirements are fairly strict, and what I mean by that is however the ownership of the operating business is set up. So if it has 5 shareholders of an operating business, the ownership needs to mirror the micro captive ownership needs to mirror the ownership of the operating business. I'll explain in a few slides, that can be fairly restrictive, especially if the business owner needs to do or wants to do a little bit of wealth transfer planning or estate planning and create an opportunity for the next generation to possibly own the micro captive. They can't do that under the 831B structure. Also can't use like Craig mentioned earlier, any other alternative shareholders such as a retirement plan. Every state has and every jurisdiction has certain regulations that have to be followed. So generally those fall under the purview of that state's insurance department. Different states have different rules and have different requirements to comply with their statutes. And then, like I mentioned, this is a revenue generation opportunity for those states. So how they make revenue is by charging what are called premium taxes, so that they even if the insurance company does not have an income tax in that state, they have to collect and remit a premium tax to that state based on a certain percentage of all premiums that they collect, and it just ranges from one state to another. It can be as low as a 0.5% to as high as 5.5%, I think currently. And then a lot of these micro captives share risks with other. If you can't afford to set up your own micro captive, you generally are involved in a risk pool, which means that every dollar of premium that you pay, a portion of that is set aside and can be accessible by other participants in that shared pool. So even if you didn't file a claim and somebody else did, they could erode the premium that you paid in because that pool then gets depleted to pay out that claim. So that's just one of the other factors when you're looking, if you do go down the path of looking at a micro captive. So like I mentioned before, there's several limitations. Investment options may be limited to government securities or things that are highly liquid, just so that if there is a claim filed, that there's money to be able to meet that claim. So you can't go invest the money in whatever you want to. Generally, distributions to the shareholders have to be pre-approved. And again, I'm only talking about micro captives here. Most captive insurance companies are subject to a periodic audit. Could be every 3 to 5 years. And if they do anything wrong, they could risk being put into receivership by the insurance department. So the business owner loses all control. And then, like I mentioned, there's generally a premium tax that's imposed on every dollar of premium that is remitted. What we subscribe to with Alliance Reinsurance Company is what is called a reinsurance company. So we partner with a third-party insurance company, and basically what Alliance Reinsurance Company is doing is reinsuring a portion of that risk that the third-party insurance company is insuring for. So the benefits of a reinsurance company And depending on which jurisdiction you look at, and the one we have chosen to partner with is a very insurance company friendly jurisdiction of the Modoc Indian tribe. And there's several Indian tribes that offer their legislation in private insurance as well, but we've chosen the Modoc tribe. The benefit of that is the premium tax is a low 1%. We can capitalize that Alliance Reinsurance Company with as small as a $50,000 investment, which is compared to a lot of other states that have capitalization requirements, meaning that the shareholders have to put in money for the purchase of their stock that can range anywhere from $100,000 to a couple of $1 million, depending on what state you're talking to. In this situation, it's a flat $50,000 stock investment. Revenues, unlike other micro captive companies that set these up, or other companies that set up micro captives, or even other reinsurance companies, generally the revenue requirement to set one of these up could be as low as 1.5 million. Usually it's higher than that, in the $2 to $4 million range. So it prices itself out of the smaller business market who would otherwise want to do this strategy. With Alliance Reinsurance Company, the recommended revenue, it's not a hard line, is generally about $500,000, just because generally for a client that has a business smaller than that, they may not be in a very high tax bracket, and therefore the cost benefit of setting up their own reinsurance company may not or may exceed the benefit. So we've just set that as kind of a top watermark that just as a general rule. But we have several clients that have other side income, like a W-2 job, and then they have a business that may or may not be generating 500,000. They might have less revenue, but they have a lot of insurable risk, and because they're in a high tax bracket, it still makes sense for them to consider this. Probably the biggest benefit of a reinsurance company is the flexibility of ownership. So that can be this opens up the door for pretty much an unlimited number of types of owners that can participate in owning the reinsurance company. Unlike the micro captive, it does not need to mirror the ownership of the operating business. So if the business owner wants a family trust where they can start shifting some wealth down to the next generation, or maybe it's a lower tax bracket, they can do that. If they want to have their kids get involved outright in the business, they can do that. And then, like Craig mentioned, even certain qualified retirement plans can own stock in this company, as long as the prohibited transaction and prohibited party rules are met. So anyway, there's a lot of opportunity, maximum flexibility here. So that's I think one of the biggest benefits, as well as just a lower revenue threshold to allow smaller businesses to be able to participate in this incredible opportunity. Lower costs generally with a reinsurance company. With Alliance Reinsurance Company, there's a $7,500 actuary fee that allows us to get that independent report that's necessary to know how much premium a particular business owner might have. There's a ceding fee that is charged by the third-party insurance company. It's a flat 17%. And out of that 17%, they then pay the ceding fee to the Modoc Indian tribe of 1%. So that extra 1% is not on top of the 17%. And then there's an annual cost that Alliance Reinsurance Company charges to maintain all of their bookkeeping and records, and when claims are filed, of 1% of whatever the asset value is inside of the company. There is, like I mentioned, with the Modoc tribe, they have very simple, very user-friendly or insurance company-friendly regulations. There's no oversight. There's no audits. There's no pre-approval to declare dividends. And probably a high other benefit is that there is no sharing of risk with other business owners. So every shareholder in Alliance Reinsurance Company who their business self-insures risk, only their net premium is available for their claims. Nobody on the outside or any other shareholders can access anybody else's net premium or the reserve that sits there. And then, like I mentioned, the premiums are generally a lot less. They can be as low as $50,000, which, I would say that probably is the minimum that it makes sense for somebody to go through the effort of setting one of these up, just because there is a lot of work and commitment, and if you're only putting in $50,000, you have to measure that time and commitment next to the tax benefit of being able to deduct the $50,000 premium on your business return. Like I mentioned here, this is just a different structure, a different alternative or structure of how you can have several businesses that are self-insured by the third-party insurance company. That risk can be carved up among other types of insurance companies that could be, and you could have multiple companies all being reinsured. You could have one. You could have a different group of investors in one insurance company than another insurance company. So, and Craig, did you have any addition to this slide?
Well, only that in this sample, we're showing that the dividends end up in a self-directed Roth IRA, which CPAs love. So, in a sense, instead of being capped by the regulatory piece of Roth, by way of the premiums being identified of risk, you bypass that. If you're doing a $50 million business, 10% of 50 is 5, and you could drop that in, and that ends up in your self-directed Roth going through the alliance as a preferred shareholder. So this has some really attractive benefits, and that's what this slide is trying to showcase.
Great. Thank you. So just in summary, kind of 3 bullet points here. The Alliance Reinsurance Company model, or what we call the ER3 plan, gives high income business owners, an opportunity, that have income with gross revenues with at least $500,000, just so it makes sense from they're in a high enough tax bracket for them to do this. The premiums that they pay to the third party insurance company are, if they are for business risks, they are then treated as deductible business expenses on that business's tax return. And then to the extent that you couple this with a retirement plan strategy that Craig had mentioned, i.e. a Roth 401k or Roth IRA, then that allows that that stock investment to grow income tax free. And then assuming you meet the rules of the Roth or of Roth IRAs or 401ks, and wait until you're 59 and a half to take that money out, that money can come out completely income tax free. Meanwhile, as the dividends are paid out each year, to the Roth 401k, that money can then be redeployed by the client. These are self-directed retirement accounts, so we don't manage that the investment piece, but it allows the client to then redeploy that dividend into other investments that they choose to buy, assuming that those can all be owned by their Roth 401k plan. Just to, again, to review the costs and the services that are provided. So with Alliance Reinsurance Company, there's a one-time capitalization of $50,000. That's a purchase of preferred stock. That's a unique class of preferred stock to that particular shareholder. The third-party insurance company collects a 15% seeding fee of all the premiums that are paid. There's to get the actuary report, which is usually the first step that we want to go through even before we capitalize the company, and obviously before the premium. There's a one-time actuary fee of $7,500, and then Alliance Reinsurance Company charges a 1% management fee to run the company and basically do all the accounting and the administration. If you use a third party custodian of a retirement plan, they might have separate, or they all have separate charges, fee structures. The one we partner with, the Interest Group, they have it's very nominal in terms of the fees that they charge to allow us to use their 401k platform. And if the investments, because the Interest Group or whoever the custodian is has to file the annual tax return for the retirement plan, if the client takes their dividend and goes invests in a difficult to value asset, the actuary or the custodian is going to need to know what the value of that is each year when they prepare the return. So they may require a separate appraisal if it's a difficult to value asset. Generally, we just reflect those those assets at the original cost basis, and that usually suffices. But if there's a very difficult asset to value that doesn't have a secondary market, an appraisal cost may also be necessary. So that talks about the cost. The services that are provided is it's a kind of a plug and play. All the filings, all the financial reporting, any kind of, if there's loan structures made, any investment assistance once the money comes out, and we need to make sure that it's an appropriate investment for your Roth or whoever the shareholders are. And then obviously when there's claims that are made, we do encourage clients to use this to file claims when they have claims. We don't want to run the risk that one of the feathers in the cap of the IRS is that if a insurance company never pays claims, or they're really an insurance company. So these are legitimate risks that have a possibility of happening, and when they do happen, we do encourage our shareholders to file a claim. Basically the money is going back to them anyway to replace the lost revenue or whatever the cost of the damage was that was being insured. So there's the money staying all in house. It's just not that's just money that won't at the end of the year get paid out as a dividend to the Roth 401k because it was more needed to recover for that loss that the business had. So anyway, when and if risks do happen and materialize, we do encourage our clients to at least file claims when they have them. That's what the money is there for. So next steps, if this sounds of interest to you and you want to find out more information, obviously we'll send you we have a QRC code that you can schedule a follow-up call. But next step, soon you want to move forward, first step or the first one would be we recommend getting the actuary study, because that's where the proof in the pudding is to know how much insurable risk business has. Once that that looks good, you want to move forward. You buy your stock in Alliance Reinsurance Company, the preferred stock, for $50,000. That has a 5-year holding period, but at the end of 5 years, or whenever you decide you don't need to own stock in Alliance, you then can redeem that $50,000 stock investment. After that, we want to determine how much coverage. Usually the report just tells the business owner what the maximum amount of coverage is, but you can always pick a number less than that if you don't want to bite off that much of a premium. You'll remit that premium to Insurance Specialties. If you're doing this for tax planning purposes, time is of the essence, especially this time of the year. We're at the end of October of 2025. We generally need to have that report finished by around Thanksgiving to make sure that everything can be set up by the end of the year, if it's important to get this in place by the end of the year. Like I mentioned, when and if claims do happen, that money sits there in a liquid account for that during that term of that policy to meet claims. If there are no claims filed, or to the extent they aren't, at the end of that term, that net premium then is paid out as a dividend to the shareholder, and then they can reinvest it however they wish. So anyway, those are the steps. It's pretty straightforward. Once you understand how the dollars flow, and we would very much encourage, if you are interested, at least to find out a little bit more information, to schedule a meeting through that QRC code, or on that link there below, to schedule a 30-minute call just to go through more details and to answer any questions. So I know this is not a live presentation, but we certainly invite questions. So if you do have any questions, you can feel free to email either my son John or myself, if it's easier to do that versus just scheduling an introductory call. So I think that's the end of today's presentation. I want to thank everyone for listening to this, and we very much encourage you to reach out and let us see if this might be a good fit for you. Thanks again.